Jensen Huang built a tech empire. As the CEO of NVIDIA, he is an engineering icon and the 10th richest person in the United States, sitting on a personal net worth of roughly $127 billion. In the United States, there is a specific rule for fortunes of this size. When a wealthy person dies, the federal estate tax requires them to pay 40% of wealth over $27 million to the government. This tax was originally designed to prevent the creation of permanent dynastic wealth. It was an idea supported by early titans of capitalism like Andrew Carnegie, who believed massive inheritances rewarded selfish and unworthy lives. In theory, Huang's eventual death should trigger a massive tax bill. Instead, his estate is currently on track to pass down his fortune while saving his family roughly $8 billion. He isn't hiding briefcases of cash offshore. Every maneuver is entirely legal. High-priced tax attorneys have engineered a series of complex trusts and charitable funds to completely bypass the intent of the law. The mechanism built to regulate the ultra-rich is actively being dismantled from the inside. The shielding of the Huang fortune started small. Back in 2012, Huang moved about $7 million worth of NVIDIA stock into a highly specialized legal structure. He used a financial vehicle known as an intentionally defective grantor trust. Tax professionals affectionately call it the I dig it. Here's how it works. A billionaire places cash into the trust, then loans it even more. The trust uses that combined cash to buy company shares directly from the billionaire. Because those shares sit inside the trust, they grow estate tax-free. That initial stock multiplied exponentially and is today worth $3 billion. The I dig it is a standard playbook for the ultra-wealthy. Politicians, executives, and private equity managers have used identical trusts to shield billions from the Internal Revenue Service. Trusts and estates lawyers consider this a grand slam. It circumvents the estate tax and the gift tax, turning what should be a $1 billion tax bill into a few $100,000. 4 years later, NVIDIA positioned itself at the center of the artificial intelligence boom. The company's stock exploded, soaring over 800%. To protect this rapidly expanding wealth, the Huangs adopted a second strategy. They set up grantor retained annuity trusts, or GRATs, a financial loophole first stress-tested by the Walmart family in the 1990s. A wealthy individual transfers shares into the trust. The trust agrees to slowly repay the initial value to the owner, plus modest interest. But if the stock price goes up faster than that interest rate, the trust keeps all excess profit, passing it to the heirs entirely tax-free. The math on this is staggering. The Huangs placed about $100 million of NVIDIA stock into these trusts in 2016. Those shares are now worth $15 billion, shielding $6 billion from taxation. The Internal Revenue Service actually tried to fight this arrangement in court, but in the year 2000, a U.S. tax court judge upheld its legality, formally installing a multi-billion-dollar bug directly into the tax code. Starting in 2007, the Huangs added a third layer to their tax strategy, using their personal charitable foundation. They donated $330 million in shares, which immediately lowered their income tax bill. By law, foundations must give away 5% of their assets to charity yearly to keep tax-exempt status. Billionaires satisfy this by transferring money into donor-advised funds. These are essentially black boxes. The money goes in, satisfying the government's rule, but there is no legal requirement to actually distribute it to an active charity. Today, the Huang family's donor-advised fund holds roughly $2 billion worth of NVIDIA stock. Simply by parking it there, they have cut their future estate tax bill by another $800 million. By routing money through this philanthropic loophole, the family retains control over a massive pool of capital. When the donor dies, control of the fund simply passes to their heirs without incurring a single cent in estate taxes. These three tools are completely standard across Silicon Valley and Wall Street. Executives at Meta, Google, and Blackstone use identical structures. This chart shows the wealth of the top 0.1% compared to federal estate tax revenue. While the wealth of the richest Americans has quadrupled since 2000, the revenue collected by the government has barely changed. The government allows this to happen because the agency responsible for checking the math has been systematically gutted. Years of budget cuts have caused the audit rate for estate tax returns to plummet from 20% to just 3%. Rather than patching the loopholes or restoring audit funding, a significant faction of lawmakers actively campaigns to abolish the estate tax entirely, arguing it penalizes small businesses and family farms. If the tax simply kept pace with millionaire wealth, it would have generated an additional $120 billion last year. That missing revenue is enough to simultaneously double the Justice Department's budget and triple federal funding for cancer research. The laws written to tax dynastic wealth still exist on paper, but for the people who can afford to hire the right architects, paying them is entirely optional.